Good morning and good afternoon, ladies and gentlemen. Welcome to the 40th version of the Housing Market Update, HMU. Used to be the COVID setup. Thank goodness it's not anymore, but we're here with Ali Wolf and myself, Tim Sullivan. We welcome you, and being the 40th, Ali, this means that our HMU is one of the older Gen Ys, and in a couple of months, it'll be a Gen X in terms of years. Who knew? Well, it is great to have you here. And a couple quick things before we get started. Our advisory team is here to help you. We do so much stuff in the industry, but keep us in mind for any for sale, rental, mixed use, segmentation work, and a personal thank you to all of you out there that work with us. We appreciate working with you. We learn every time, and we hope we can return the favor. That's what we're here for. Further, we are doing a whole series of conferences. It's one of the things I'm most proud of with Zonda. We work with great people, and we put on wonderful conferences with many of you out there as part of the program. Notice on the left-hand side, we've got our MFE, the Multifamily Executive Conference that's coming up in Dallas in September. Please join us. Everything rental is being addressed there. Future Place is going to be in Tampa in October. Now note, it says the future of master plan communities, but it's so much more because we're addressing the new ways to make great places. And that means not just communities, but what we live in. And the far right-hand side is Elevate, the art of high-rise living. We'll be addressing what's happening with urban shifts and densities. And I hope you can join us there. That'll be in Miami. And another thing that we are launching, by the way, tomorrow, is our rental housing outlook. We call it the RHO. We love our three-letter acronyms. But notice at the bottom, you can access it there. And the concept here is that we're providing insights from our nationwide thought leaders. It's backed by our data. We're building an incredible database about it. And the whole idea is to help you with trends and create a platform from which you can make great decisions. So please check that out when you can. And it's a complement to our existing platforms because, of course, we've got Enterprise and Mortgage Pro and Building Product Pro. This is the data and analytics that will help you make really terrific decisions throughout the new home construction side. But the platform is even more because you can dive down into detail. And please, if you'd like to, check out zondahome.com market-snapshot. Get a free snapshot to see just some of the stuff you can get with the push of a button. But we are not stopping with data and insights. Note that we now have launched Livable. And what's so cool about Livable is that it is a new home listing service, and it's free. So check out livable.com. It's another way to help you just sell your homes. So with that, we have also transferred some of that knowledge. Whoops, hold on, I've got one more thing to share with you. I've transferred that knowledge into Concept Home. So if you get a chance, take the virtual tour. It's 2024 concepthome.com. Now we can get to the agenda. All right, Ali, I want you to know that my dad always said, if you find 3 great things about someone, they have the makings to be a great friend. Well, if I think about that and I relate it to you, it more than applies because I can come up with way more than 3 great things about you. But in the interest of brevity and the time that we have today, I'm going to keep it to just 3 points. And with that in mind, ladies and gentlemen, here are 3 things about Ali I want to make sure you know, and 3 of the things that I am grateful for. Number 1, Ali has a quick sense of humor. Sometimes you might not know it because she's so smart. She's coming across with such great data. But over the years we've worked together, the long hours, the stress, COVID, and everything else, laughter always came up. I'm grateful for that. Number 2, she's very close to her family. In fact, she brought her mom to one of our events in Raleigh, our Deal Makers events in Raleigh. And if you've ever seen a proud mother, you would have looked at Ali's mom and you would have seen the smile on her face. Very close to her family. And keep in mind those 2 ideas, laughter and family, for the way we wrap up today. And the third, on a very serious note, is that her insights have earned her a place on the President's Council of Economic Advisors. And that's the perfect segue into what she's going to talk about today. When you look at our 5 agenda parts, Ali will take the first 2, and I'll take the next 3. But she'll start off with the thing that everybody's talking about, the Fed attitudes, what's happening with the economy. And if you would, please help me welcome my friend Ali Wolf and our chief economist to the virtual stage. Ali, please take it away.
Awesome. Thank you, Tim. And hello, everyone. We are delighted that you're here with us for our 40th housing market update. Now, as Tim mentioned, where I want to start today is with the interconnectivity between the Federal Reserve and the economy. Because as we all understand at this point, we have seen 10 short-term rate increases from the Federal Reserve since last March. What I think is less understood, though, is what a historic period of time we're living through. Now, if you think back to the past times that the Federal Reserve has raised short-term interest rates, going back to the 1990s, 80% of their increases were 25 basis points, and only 10% were 75 basis points. Where we are today during our current hiking cycle, we've had 40% of our increases being 25, the 3 so far this year, and the increase last March. But we also have 40% of our increases that have been 75 basis points. And what this really highlights is the resolve and commitment by the Federal Reserve to get inflation under control. Now, when I say it's historic, I wouldn't say that it's unprecedented, because what we've experienced right now is a Federal Reserve increase of about 5%. If you think back to the 1970s, this is a point of time a lot of people turn to because it was the last time that we did have extremely elevated levels of inflation. Well, back then, instead of a 5% increase in short-term interest rates, they had a 14% increase. So it is historic from a near-term point of view, but not from that longer-term and historic point of view. But as we look at this, and we think about what the Federal Reserve has done, we talked about the 10 increases, and we know that the Federal Reserve skipped their short-term rate increase in June. And they did so because of something that we've been talking about for the past few months, which is the idea of long and variable lags. The Fed has raised rates, and I think it's very easy to assume, okay, Fed raised rates, we know what that means for the economy. We've already felt that on the ground. When in actuality, that's not the case. It takes a long time, and we've known this since the 1960s, that it takes a long time for the Fed increases to filter into the economy. Their idea and their choice to skip, or you could say pause, their rate increases in June was for them to be able to collect a little bit more information. And it's a little bit of a strange thought, because our anticipation is that they're only going to pause for 1 month. So they only really collect 1 month more of data. But think about the Federal Reserve's goal, maximum employment, price stability. We know that they're going to have been looking at the most recent data coming from the labor market and from inflation. And that's how I want to address this discussion. What can we learn from this data the same way that the Federal Reserve is learning from it? Well, the key thing that we know is that the labor market has yet to post a notable cool down across the economy. We've had 6 jobs reports so far this year, with an average of nearly 300,000 jobs added. I think the big wow to me, while I was pulling up these numbers, is that we have a 3.6% unemployment rate. And we'll talk about this again later, but the Fed is raising rates to slow growth. Last March, when the Fed started raising rates, before they increased them 5%, the unemployment rate, 3.6%. When you look at some of the layoffs that have happened in the economy, what we also know is that those that become unemployed are often able to find another job quite quickly. We're still seeing this resilience in the economic backdrop. And if you look at total employment, what we're seeing right now nationally is we're 3% above pre-pandemic levels. Now, for this map on the right, 3% would be 103. So it's basically, if you're 110, you're 10% above pre-pandemic levels. And as you look at this map, the more green the number or the dot, the higher the percent of jobs above those 2020 levels. And you can see we have those green across the Southeast, across the Southwest, and I'm sure your eye was drawn to Austin. Austin has seen 5 times the growth of jobs compared to the national average. You see Austin, Dallas, Raleigh, Tampa, Nashville leading the way. Now that's total employment, but you can also look at high income employment. And nationally, we're 6% above those pre-pandemic levels. And now you can see the concentration becomes more of Texas and Southeast when you look at high income job growth. Again, Austin leading the way, this time 30% above 2020 levels. Still Dallas in the top list, Raleigh in the top list, Tampa. What we've done here is just as the data has switched, we moved out Jacksonville for Nashville. So just a slight difference in the top 5 compared to the slide we just showed. So Federal Reserve is looking at this and saying, geez, we still have so much strength. We have strength in the employment backdrop, and we have strength when it comes to wage growth. The Fed has been watching wage growth carefully, especially as how it relates to inflation. Most recent data came out, wage growth up 4.4% compared to last year. But let's look at historical data when you think about wage growth. So economists like to look at wage growth in real terms. What that means is adjusting adjusting wages for inflation. So you can have positive real wage growth, meaning you're bringing in more money than the inflation rate. You could be flat at that 0%, meaning inflation and the income increases are about the same, or you could be negative, meaning people are falling behind every month because inflation is exceeding their earnings. As you go back to 2006, we have had a couple periods where real wages have gone negative, but for the majority of the time, we've been flat to positive. Then look at what's happened since the pandemic. When we look at this data, we have been living through an environment where real wages have been negative. People have not been bringing in as much as the overall inflation rate, which is why for so many months now, we've been talking about inflation and tracking it and watching it. Big difference though. We've hit this inflection point where the most recent data shows us that real wages have gone positive again. Now they've gone positive because we got a great inflation report last week. Now, before I tell you about that report, let's remind ourselves about inflation. It's a general increase in overall pricing, and there's 4 main ways to track it. You can look at the Consumer Price Index, CPI, in a core way or in a headline way. You can look at PCE, Personal Consumption Expenditures, core and headline. Core excludes volatile food and energy. What we got in our CPI reading last week was that headline came down to just 3%. This time last year when we were meeting, inflation was 3 times today's level at 9%. So this was a massive move in the right direction, a really good read. But remember, headline CPI is one of 4 ways to measure inflation. If you look at the collective picture, inflation is still up between 3 and 5%, where the Federal Reserve wants to see it at an average of 2. So still running hot, but absolutely improving and moving in the right direction. But the fact that we do still have elevated inflation this far into where the market has been really begs the question, well, what are the key sectors that are influencing inflation? Now, of the top 3, here's your list. Transportation services, number 1, shelter, 2, food away from home, 3. Now, I point this out because number 1 and number 3 are discretionary. You do not have to go on that European vacation. You do not have to go to that restaurant. If things got too tight, you could pull back on those. Shelter? It's a basic necessity. This is something that is not discretionary. It's not only somewhere that we want people to have a place to live, but it's also so important because of its relative importance to the overall inflation read. We've talked about this in the past, but I think it's worth bringing up again that if you look at CPI, Consumer Price Index for inflation, shelter represents 43% of the overall number. And as you look at shelter historically, it is an absolutely lagging indicator. It takes 12 months usually for a slowdown in shelter to show up in this data, which is why most people feel quite confident that inflation is going to continue to move in the right direction. Because if you look at that blue line, we've only slightly started to have that rollover. I think the caveat here is that in the next section and throughout this presentation, we're going to talk about the outperformance of the housing market. And as you think about that, if we see housing get too strong too quickly, that could put some of these improvements at risk. But you step back and you take all of this into consideration, all right, we know the Federal Reserve skipped their interest rate increase in June. Now they have 4 more chances to set the policy rate this year. One is next week. We have September, we have November, and we have December. The Federal Reserve has one of 3 choices that they can do at each of these meetings. They can raise interest rates, they can skip or pause again, or they can cut. Now, as we look at the idea of the Federal Reserve raising interest rates, our belief is it's almost a guarantee that the Federal Reserve will raise interest rates again next week. We think they will raise rates because we just went through the key things that they're watching. Labor market's still hot, inflation's still hot, both of them moving in the right direction, both of them not at a point that the Federal Reserve is ready to say game over, or at least we don't believe that they are. So we think we'll see the increase in July. We think there's a chance they raise rates again in November, but that's completely data dependent on how the economy continues to progress. From that point, though, the next thing the Federal Reserve will do is pause. Now, they will pause once they get to a point that they believe interest rates are what they call, quote unquote, sufficiently restrictive, meaning they're slowing the economy enough. With all hope, they don't push it into a recession, but they want to slow growth. They don't want us to be with high levels of inflation in a frothy environment. Once they get there, they'll pause. The third thing, though, is what about a cut? And if you joined us for our last housing market update, Tim had asked me, do I think that a cut is likely this year? And I believe that I said I don't think it's that likely this year, and I would stick to that same answer. Because you have to ask yourselves, what would be the conditions that would warrant a cut? Well, the conditions would be that the economy has slowed extremely dramatically. We probably are experiencing negative job losses. We're probably in a deflationary environment. And by the way, the data has to have turned negative and been negative for more than a few months for the Federal Reserve to feel confident that it's not just a data issue versus an actual shift in the trend. We're sitting here in July. We don't have that many more months this year for everything to really turn bad and for the Federal Reserve to believe that it's bad and it's going to stay bad. Once we get to that point, though, that's when it warrants the Federal Reserve cutting rates. When they feel that the economy has come down, maybe it's in a recessionary environment, maybe it's just an environment that they've really slowed growth and they think that we could use a little bit more stimulus or really stimulation to the market to help drive overall growth. So when you think about a cut, we don't believe, at least based on what we know today, that the Federal Reserve is going to cut rates this year. In fact, historically, what we know is that once the Federal Reserve pauses, they stay paused for an average of 10 months. Now, on the short end, they pause for 5 months. And so that could actually get us to November of this year. On the high end, they pause for 18 months, which could bring us through the end of next year. But this math is based on the Federal Reserve pausing versus skipping. And that's why that part is important. Did the Federal Reserve skip in June and will they resume hiking in July or not? Because that changes the timeline of when a cut might be likely. But more specifically, the reason we care about it whatsoever is because we're trying to think about the impact on mortgage rates. So let's think back to when the Federal Reserve was raising short-term interest rates. So they were going through the rate hiking cycle, and we were meeting with you guys on this virtual webinar, and we were saying, hey, by the way, when the Fed raises rates, it's not a one-for-one that mortgage rates go up to the same extent. What it's telling you is as the Fed raises rates, you should assume that mortgage rates are going to go up, but there are so many other factors that drive rates. That same logic when the Fed raises rates applies when the Fed starts cutting rates. In fact, we don't see that mortgage rates wait until the Federal Reserve cuts them for them to turn negative. In fact, you usually see mortgage rates have a 6-month lead time, meaning mortgage rates are already going down to the tune of about 20% from peak by the time the Fed starts cutting. That's really important because what we're saying is maybe by the middle of next year, we could already be seeing mortgage rates rolling over in advance of the Federal Reserve doing their cuts. Now, we know that every point in time is different, but we wanted to apply that historical logic to today's market. So if we saw that 20% drop, maybe by spring selling season, maybe by summer of next year, we hypothetically could be seeing rates in the low fives to mid fives, just based on what we've seen historically. Now, that's one way that we could see mortgage rates go down. But there's another that, if you have followed our research, you know we've talked about this at length, which is the mortgage rate spread. The fact that historically there's a very strong relationship between government bonds and mortgages, and that normally you would pull up the 10-year treasury and add 1.7 to it to get real-time feed of where mortgage rates are. We know that this has ballooned. We know that we now have a spread of 3. This happens during times of economic uncertainty, but we also, again, at least historically, have a reversion to the mean, where we get back to a point where you are closer to that 1.7 spread. That normally happens within 12 to 24 months. And if that were to happen, again, that has happened historically, that could get us back to rates in the 5s versus 6s. So from my point of view, as I'm trying to think about where mortgage rates might go, these are 2 very viable, very reasonable paths, at least according to history, that could see mortgage rates go down. Do I have great confidence in this? I think it's more likely than not that we do see mortgage rates move in that direction, but there are some things that I would probably give a 30% probability to that pose risks that could actually push interest rates higher, which is why we should still and continue to track inflation. Even if you're bored of talking about it, inflation poses the risk that we could actually see interest rates go up if we don't continue to follow the path of it coming down. We're assuming that this spread moving from 3 to 1.7 is going to follow that normal historical pattern. If it doesn't, there's a huge risk to talking about rates in the 5s. Federal Reserve still going through quantitative tightening. There's still risks there. If there's not an appetite of investors to buy mortgage-backed securities, that could mean mortgage rates only go higher. So certainly there are a lot of things that we're still watching, but again, we think there are a couple of paths that are reasonable to seeing interest rates come down. If you think about this from a consumer point of view, and you think about how they might view the market, cuts could be stimulative. And that's kind of the point of them, is that you may have people on the sidelines that are saying, oh, we moved out of the market, but now it sounds like mortgage rates are going down. I may want to enter, assuming we're not into a bad place in the economy where maybe they want to, but there's some challenges related to that. Now, at this point, though, you got to ask yourself, okay, well, why did we spend about 15 minutes going through those trends in the economy and with the Federal Reserve? Well, it's because that interconnectivity is not just between the Fed and the economy. It's the interconnectivity between the Fed, the economy, and the housing market. We care because it has a direct impact on our industry. But as we look at the new home market, we know that consumers have actually been surprisingly active despite those 6 to 7% interest rates. In fact, our data at Zonda shows that we are above, in terms of total sales, above those 2019 levels, which stands in direct contrast to where we were at the end of last year. Let me reiterate what we said. The Fed is raising rates to slow the economy. They know that traditionally housing is one of the most interest rate sensitive sectors. They know that housing will oftentimes take the hit of those higher rates. We saw that last year. We saw the overall demand pool come down. We saw that we don't have as many active consumers. That happened last year. We still have a smaller demand pool in general, but there's been an unintended consequence of those higher rates actually having a greater impact on supply today than it has in the past. So demand is down, but supply is down even more. And the resulting impact is those that have inventory have been able to benefit from how the market has progressed. Average sales rate. Many of you know we like this. It's sales adjusted for supply. And a big, massive change compared to what we saw at the end of last year is we now have a handful of markets where their current sales rate is above 2021 levels. That's the height of the market. And yet we've had a more than doubling of interest rates. The challenges with data, of course, is that it's actually comparing a bit of apples to oranges, because we know during 2021, the average sales rate was held back. The market was not operating at its full potential because builders were intentionally capping their sales. So it stands out, but it's not the key takeaway. I think the thing here is what we're finding is most markets across the country are not only performing above their 2019 levels, but performing notably above where they were going into the pandemic. And it makes sense because we're living through this really unique period of time in housing history. We've talked about in the past how builders have gained overall market share from an inventory point of view and from a sales point of view. And it makes sense because builders right now have the ability to do three main things. They have the ability to capture buyers that traditionally want to go in the resale market. Why do people like the resale market? Well, part of the time it's the charm and part of the time it's the location. But oftentimes people are saying, I want to buy a home. I want to lock in my rate. I want to move in fairly soon. And I like the fact that I can see what the house looks like, how the floor plan lives, what finishes are already in it. Builders have a direct competitive product right now. And we've seen that the product has only grown compared to last year, which is the quick move-ins, homes that can be moved into within 90 days. So builders can capture some of that share of the I want to move now buyer. But builders can also work with discerning buyers. If you think about the homes that are available today, you have opportunistic sellers that realize there aren't many other sellers that are competing with them. So they can sell at a fairly high price and they don't have to put too much time and money into it. Well, for some consumers, they're saying, if I'm going to pay top dollar, and I'm going to pay with today's interest rates, I actually want a nice product that goes along with it. And to-be-built homes from builders lost a little bit of favor over the past few years when it took 12 or 15 months to get these homes built during the worst of times. Now we've seen a massive shift. 75% of the builders we're talking to at Zonda are saying that their cycle times are down to just 4 to 7 months today, where 6 would be that normal reverting back to where we were pre-pandemic. That's really helped the to-be-built buyers. And then we've talked at length about this. Builders can also work with the affordability challenged buyer. I just got an email from a builder that said that they're offering up to $50,000 towards closing costs. You're not finding that in the resale market. Not only that, but we know that mortgage rate buydowns are still an important and big part of the overall market. We have 40% of builders that we're talking to that said over 50% of their buyers are using buydowns. And frankly, I'm surprised it's not higher, but I think this relates to the conversation that we had the last time we met and we did this update, which is there are a lot of buyers that aren't as interest rate sensitive, and they actually would rather use some funds towards options and upgrades. So we've talked about builders gaining share in this unique period of time. But we also know that we're entering into, and really we're living into, the seasonal slower time of the year. For the new home market, February through May are normally the strongest, and then you have the seasonal slowdown. But we haven't really experienced a normal seasonal slowdown for the past 3 years. If you look at 2020, that's the orange line, you almost have an inverted spring selling season where we lost it during the first half of the year and absolutely gained it during the second. Look at 2021. A little bit of a slowdown, so that's the mint color, a little bit of a slowdown June, July, and August, and then levels of activity ramped up and a lot of growth towards the end of the year. Look at 2022. That was an abnormal period of time because we had the doubling of interest rates, we had the headline risk, we had the consumer confidence concerns, and we had a greater than normal collapse in overall sales than you would imagine during that seasonal time of year. This year, we're expecting a little bit more of a return to normalcy, that the market does follow the seasonal pattern. And as we layer in our qualitative information from our builder survey, we have the highest response from builders for June, saying demand is on track with what was expected. But the second highest response is demand is slower than expected. But notice that it's slower than expected, but not worrisome. And as we looked at the builder survey, the comments were just filled with mentions of summer seasonality coming back. And it makes sense. How many times have you read an article recently talking about how many people are going out into the service side of the economy, how many people are distracted? This is a headline, tourists are packing European hotspots, boosted by Americans. We know that those summer distractions have returned in today's market. But as we look at housing, we'd be remiss to not also mention what's happening in existing, which continues to be the largest share of the overall market. Existing home sales, both nationally and locally, down, both on a year-over-year basis and compared to 2019. Now, sales are down for 3 main reasons. 2 of them also apply to the new home side. which is sales are down for consumer confidence reasons, sales are down for housing affordability reasons. But the third key thing and really important from the existing home side is that resale inventory is really keeping a lid on how high overall existing home sales can go. And it makes sense. Again, looking at listings both nationally and locally, we're finding nearly every single market has listings down compared to 2019 and down to the tune in many areas of down 20% to down 60%. This has allowed builders to gain that market share. But what I would also say is this is a sign of a pretty dysfunctional market. This is not a market that is operating efficiently. This is not a market that I think is sustainable longer term. And so what we did is we tried to challenge ourselves of what could be a viable path to get out of this dysfunctional market and to get to something that feels more healthy. Well, we know increased housing starts is an important discussion point. And as we're meeting here today, we got that new starts report from the government, and we saw that there has been this notable increase in starts. Tim will talk about that more in his section. But we also believe that a viable path to get us out of this market is that you do have more homeowners that are willing to sell once interest rates fall. Now, the hope is that interest rates do come down, and we already talked about the two paths that could lead us there, the Fed rate cut and the mortgage rate spread compressing. But I wanted to do some very, very basic back of the envelope math. So we know inventory is low because 90% of people have a rate under 5, 60% of people have a rate under 4. Now, if you just looked at someone that was living in the median home price right now, and they wanted to move out of that house, and let's just say it's a lateral move and they have a 4% interest rate. The challenge is they're facing, just on a lateral move, a $600 a month difference. That's why people aren't moving. That's why we have this lack of mobility. But let's say market rate comes down. In the best world, let's say they get to 5. We're not anticipating rates go down to 2, 3, or 4 anytime soon. But if you had someone at a 4% interest rate and they have to move to 5, all of a sudden that feels a little bit more reasonable. And I think in some ways people feel like their handcuffs come off. They actually can move. 190% difference is way different than a $600 increase. And we think that that's actually a reasonable thing that might happen to the market given what we believe to be pent-up demand. So we have the lock-in effect. People don't want to resell their homes, but think about people that have bought their homes over the past few years. You had to wait in lines to tour homes in some cases. You had to make rash decisions, purchase a home, or put in an offer pretty quickly, oftentimes over the list price, oftentimes waiving inspections. There was this frenzy, there was this fear of missing out, where now, as a couple of years have passed, there are some people that feel dissatisfied with their current property. And Todd Tamilak, he's our building product and remodeling expert. He dug into the data from the New York Federal Reserve and found that we have this really interesting trend that's happening. In 2019, we had 10% of homeowners under 50 that were looking to move again within 2 years. 2022, 2023, that's now over 25% of people that are looking to move within the next 2 years. To us, this captures pent-up demand of people that are reluctant to move right now, but may be willing to if market rates start to compress and get closer to what they have locked in. In fact, Todd's call right now is that he thinks we could be living in, right now, the lowest mobility year in history. But at a certain point, we do think there's some of that pent-up demand that could ultimately come and hit the market. But as we look at supply, I think one of the key things to think about is, yes, there has been this advantage from builders, but we also want to be aware that if we do ultimately see an increase in supply and some return to the market, that will dampen a little bit of the builder advantage. But make sure you distinguish between good and bad sellers. Those people we just talked about on the last slide that want to sell and move and buy again, we think they're neutral to positive in the overall market. Just helps with overall mobility, helps with overall turn. What we're watching for, though, is any kind of increase in what we're calling bad sellers. And a bad seller basically is someone that sells their home, but does not also become a buyer. We wrote a blog on this on Builder Online. You can search. We went into more detail in the blog, but we think that this poses a risk to the market. One, based on pricing. that if you have more supply, maybe that could change the pricing dynamics that we've been living through. A risk related to competition, because right now our main competition in the new home side has left the game in most cases. And also this increased supply just increases overall uncertainty. Now, what do I mean? Who comprises the bad sellers? Well, one would be investors, whether that's flippers, whether that's people involved in the built to rent space, rental landlords, Airbnb owners. We know that during the height of the market, we had the highest share of investor purchases in the market that we had ever seen, higher than what we saw during the mid-2000s housing boom, highest going back to the year 2000. 20% of all of the purchases were done by investors nationally. It was 30% in some select markets in Charlotte, Jacksonville, Vegas, Atlanta, Phoenix, so Southeast, Southwest. We know that investors by a lot of accounts have every reason not to sell, but if there was something that shifted with their finances where it no longer made sense, that to us would pose a risk of a bad seller. What about second home buyers? Well, we know that there was a 90% increase in second home buyer activity during the height of the market because of low interest rates, because of accumulated equity, and because of changes in lifestyle, because of work from home. What if some of these second home buyers realize that they actually don't use the home that much, or they can't continue to work from home, or the home has become a financial burden? Each of these different things could impact the overall housing supply. And you see listed here the top 5 markets. We're watching places like Ocean City, New Jersey, like Naples, Florida, like Flagstaff, Arizona, to see if there's a shift in overall supply. And then the third thing we're watching is any kind of unemployment related sales. Now, I will say we do not believe that we are on the way for a foreclosure crisis. I think most people agree with that as well. We know people that have bought have had skin in the game. We know that they have accumulated equity. We know that they have had very good credit scores. We know it is very, very different to the environment we saw during the mid-2000s. With that being said, the Federal Reserve themselves believes that the unemployment rate will go up to 4.1% from 3.6% by the end of this year and go up to 4.5% by the end of next year. What that means, if their estimates are correct, is we have 750,000 fewer workers at the end of this year and 1.5 million by the end of next year. There's no reason to believe people will go into a forced sale or a short sale, a foreclosure, but some of those people may need to sell their homes, and they'll probably become a seller without becoming a buyer. So our base case is not that we see a massive increase across all of these, really by no stretch, but we do think there's a chance each one of these categories could contribute to increased housing supply, and from our opinion, absolutely worth watching. Now with that, I would like to turn things over to Tim for him to go through more things that we think are worth watching, but let me reintroduce him to the group. So Tim Sullivan, you know him. He is our Senior Managing Principal of Advisory. Tim oversees our entire custom market study business, including land banking, feasibility studies, and local economic analysis. At this point, many of you know that Tim has over 35 years of experience, is the most sought after MC in our industry, and can provide valuable insights on the state of the market given his boots on the ground approach to market research. I think more important than all of that, though, is Tim's relationship with his family, his wife, Danielle, daughter, Riley, and sons, Declan and Parker. Tim supports his wife, Danielle, in her own professional endeavors, but you'll also see her supporting him at many of our events. Tim's daughter, Riley, is a recent USC grad, and until graduation, Tim would drive up at least 2 hours to see her dance recitals. Declan and Parker are both busy working, one at Universal and one doing 3D designs of biotech buildings, but they still all find time to have family vacations and to celebrate big wins. And I think it's his connection with his family that keeps Tim grounded and keeps him humble. Tim, let me pass it to you.
Thank you very much, Ellie. And as fate would have it, we're having a family reunion this weekend up at Atascadero. So you nailed it. Thank you for that. A couple quick things before you go, and I'll set this up as a true-false question because I appreciate that you went into the conversation about which direction the Fed's going to head, and it's almost a guarantee that we'll see the Fed funds rate go up in July, I guess next week. True or false? The increase will be 25 basis points.
True.
See how I did that? I didn't ask you a number. I just asked you false.
Appreciate it.
Yep, Allie doesn't like those numbers. We have a couple really cool questions. And guys, I think I can only get to two of them. One has to do with student loans. And Dean is asking, will the restart of student loan payments reduce inflation and or slow economic growth? Thanks for that, Dean. Allie?
Oh, both. We just wrote a blog again on Builder Online about this, but in theory, it should reduce inflation because you're taking away on average $300 from people that have student loans that they've been accustomed to over the past few years. Now they have to go back to resuming that payment. That doesn't go out in the economy. So that should help inflation. But by default, consumers represent 70% of the economy. That same money that's going to the consumer loans then gets pulled away from consumer spending that could contribute to a wider pull down in the economy.
Right on. Eric, you have a good question. I'm actually going to address it related to tightening credit standards. So we'll put that one aside. And speaking of family members, Randy reached out, and this is more in the general sense, Allie, but I'm really interested in this too. And Randy asked, why is there so much discussion on Fed rate changes fighting inflation, while there isn't a lot of discussion on the effects of government continuing to flood the economy with unprecedented deficit spending? And that's a quote.
Is it a question or is it just a mention?
Yeah, why is there so much discussion about it? Let me spin it so that you can zero in on this. What's the impact of government spending? And do you see it pulling back? You know, because right now we're focused on Fed funds rates, but the government continues to spend. Isn't that an inflationary impact?
Yeah. Well, how do we get to this mess in the first place? And by the way, it was both the Republicans and the Democrats spent money like it was water, and that got us into this problem. Continuing to spend money, of course, is an issue and continues to be inflationary. But I think the reason that people talk more about the Federal Reserve is it feels more market moving. You can track it every day. We know the timeline of the Federal Reserve. We know that they're going to have minutes. We have multiple things that come out on a regular basis that we can track and use it, versus the government spending is something that feels more long-standing and harder to point to the immediate impact, even though we understand broadly that it's inflationary.
Beautifully said. And thank you for that, Allie. And with that, we will continue on. So, ladies and gentlemen, think about this graphic for a second. Look at the jagged element about it, but importantly, also look at the element of how this price spread has changed. Go back to 2016, and the price spread between new and existing, with new being higher, would range 30 to even almost 45%. Now go forward. The difference is 4%. You heard Allie talk about why that is. And certainly on the resale market, we've seen less product. So the product has seen an increase in pricing, and builders have been smart in terms of the product that they're shifting. A lot more density, smaller products, so that absolute prices go down. And Allie, one of the things we might want to do going forward is looking at this on a per square foot basis, because I think that will show some interesting things with builders that have started to build a smaller product, and absolute prices are still, pretty healthy, and that price per square foot is up. So that's something for our to-do list. Now, the pricing power exists. I really want to focus you on the teal color, because that teal color goes back to November of 2022. And when we asked the question about which way you're taking base prices, are you increasing, decreasing? Look at that number. I mean, we're at a place where the vast majority, 90+% of the respondents said either we're not increasing prices or, God forbid, we've lowered them. Now, fast forward to where we are now. And, we're in a position where over 50% of the builders are increasing prices, but we note that they're being careful. And when we talk to builders, when we're in the field, when we're looking behind the scenes at new acquisitions, caution is definitely the word of the day. Now, in taking care, one of the basic reasons is affordability is a concern. So look at the left-hand side of the graphic. When we ask the builders, your biggest hurdles related to demand, tell us everything that's out there. You really look at the left-hand side, and mortgage rates and affordability, home prices, people choosing to wait and see, which, by the way, the implication is that prices have been high enough that anecdotally, people that I talk to in my neighborhood are asking, well, will prices go down? Now, that is very much a very specific neighborhood by neighborhood take. But as you can see from a supply and demand element right now, We don't have a whole lot of support for that because there's been restricted supply. But keep in mind what Ali was talking about with those bad sellers, because there could be a shift over time. We're going to monitor it. And one last thing on this, look at the not having enough homes to sell. Doesn't matter if that's on the resale side or the new home sale side. As a reminder, when we do our surveys with the builders, we're covering probably the equivalent of 25 to 30% of all new homes that are being sold in terms of the number of builders that we interview. So the numbers are pretty significant. Okay, now let's do a little comparison here. You can see on the left-hand side metro areas, and we're going to show you the pre-pandemic prices and how things have changed for new and existing. And then I'm going to show you what's happened to the affordability ratio. So here we are with what's happened with new homes and existing homes and how they've appreciated since the pre-pandemic times, so say 2019. And now as we look at those affordability ratios, look down and compare the affordability ratios of new versus existing. In the old days, you go back 3, 4, 5 years, and remember the graphic I started with when there was that big differential for new and resale. The existing home affordability ratio was way higher. Now they're pretty compressed. And if you look market by market, the only market right now that has a new home affordability ratio that is higher than resale is Austin. So this has been a sea change in the market. We do anticipate as new product comes to the market, that will shift a little bit. Now, in asking about what buyers are purchasing and why are they going after it, look at the left-hand side of this. Lack of resale supply, they're relocating, having children, retirement, sick of paying rent, marriage, divorce. Those are functional things that happen no matter what the interest rate, no matter what the year. In fact, we kind of say it's the life happens element, because when we think about where and why people have left, I mean, just look at the right-hand side of this. These are not necessarily want to moves, but have to moves. Marriage, divorce, death, empty nesters, family expansion, the baby chasers, relocating, retirement. And what gives us some confidence about underlying demand is what I had just said. This does not go away. And, think back to the boomers overtaking millennials. What is that? What's that ultimate catalyst? And it's retirement. Now, there's another thing that has a little to do with it, and that's cash. And this is fascinating to look at. Ali just showed us a couple of graphics where we're seeing, for instance, the number of sales that we have investors going to be in record. Look at cash sales. Now, these are very correlated, by the way, but they're also correlated with the fact that we've got an empty nester market and a move down market with the boomers that is pretty significant. Now, this is good news for the market. There's also an underlying reason for why we see this percentage, and that is with higher interest rates, the families that can't afford to put more money in or buy cash are doing it. Now, there's a handful of markets that have behaved a little differently. And when you think about the markets that are using all cash, read through this: Cleveland, West Palm, Baltimore, Jacksonville, Cincinnati. I mean, there's some correlation here. Affordability, certainly, but also relocation markets. And think about moving from New York City to West Palm or Philly to Atlanta. The opportunities to cash out of one home and then pay cash for a lower price certainly happens. And notice what's not in here. You don't see a lot of the California markets, but I will come back to them right now. And Ali and I were talking about this before we got started, and that is when you think about the equity that is in many of our markets, and oh, by the way, when you look at the percentage, the increases have been massive. But look at the left-hand side for our coasts. And that's, of course, Washington, Oregon, and California. Look at the level of equity that we have seen. And when you compare certain markets, this is where California actually shines. California's equity, because home prices have gone up so much, the equity has been incredible. And look at San Rafael, California. Of course, that's Marin County. I mean, there's $1 million of equity in the typical home there. Now, look at the bottom, some of the markets that we don't see as much equity burned or built is, for instance, Rockford, Illinois, or Peoria, Illinois. And my family moved from Chicago to California So I guess I should thank my dad for that. So there's a little bit of equity in there. But this is a fascinating comparison. And something important as we badmouth California so often because of its nutty political environment and high tax environment, the other thing we have to acknowledge is that there's a cushion here because of this equity. And it makes Californians able to move, or as Todd Tummalock would love, able to improve their homes. All right, fasten your seatbelts because I'm going to take you on a little bit of a roller coaster ride. And this goes back to the question about credit availability. On the left-hand side of this graphic, this is mortgage credit availability. And this is from the MBA, Mortgage Bankers Association. And look how it's changed over time. Basically, credit is really, really tight. And I don't think I'm telling you anything you don't know. And many of you out there that are in the capital markets are experiencing this. But there's more to think about too. When we think about the Mortgage Credit Availability Index from MBA, there's a light at the end of this tunnel. Now, the bad news, of course, is credit is hard to get. But the good news is this strong underwriting is minimizing the long-term, I wouldn't even call it opportunity, let's call it the threat of having crappy mortgages and people defaulting. Now, remember what Ali said about job losses? That's something somebody can't control. And if the person doesn't have enough capital to stay in a home, we could see that spike up a little bit, see the concept of default spike up. But this underwriting is a very important takeaway because this gives us some strength in the market, even though right now it's very, very painful. And some of the things that buyers have always had as an option, of course, is ARMs, adjustable rate mortgages. And you look back at 2005, I mean, you saw 35, 36% of the market being ARMs, and about 90% of those were cab drivers in Las Vegas. Now you can see what's happened over time. There was a little spike up in 2023, but overall, it's really still a small percentage of the market. However, it's still one of the options. And I know some people that have bought homes recently have gone to ARMs with the anticipation they'll be able to refi 2 years down the road with lower interest rates. Now, something that we've tracked for a while is the FHA opportunity in various markets. Now, during the height of the market when interest rates were lower, the FHA loans, they were kind of eroding in terms of their prominence in the market. But there's a really important thing to think about for the markets that have FHA or when we have a mortgage with FHA. And these are some of the ones you'll look at, Riverside, Las Vegas, Atlanta, Phoenix. But most importantly, this is why we pay attention to the FHA element. Because there's price elasticity, we'll see the subdivisions that have FHA loans have absorption rates that are higher than the conventional. So think about that. I mean, it makes sense because FHA is a limit. So it's primarily going to be the lower priced. And I use that term in air quotes, lower price, because it changes so radically from California to Arizona to Texas to Charlotte. But what holds true is that FHA product will sell faster because it's lower priced. And it's a pretty easy assumption to make, but we're showing it right there in blue and teal. A couple of things on input and costs. And we are constantly asking the question of builders, what's your biggest worry? And it's always about operational things. Well, look left to right. Land prices, home affordability, jump over to inflation, Fed Reserve. The left-hand side, it's definitely affordability and cost-based, but in the middle, it's policy-based. And these are factors that aren't going away. And many times we've had, and I'll show you another slide in a second, many times we've had people ask, why can't the government work with us to figure out the lack of supply issue and the affordability issue? And I'm going to put that out there to anybody that works in a municipality. Work with us so we can figure that out. But these factors aren't going away, but notice that the levers change over time. Now, land prices, with land being, a vast majority sometimes of, a market like California could be 50% of the cost of the home. We've asked builders, every month, what are you seeing with land prices? Now, look at that third section from the left. Land prices are primarily moving higher compared to a few months ago. If you look at the teal color, that was February. You look at our deep blue color, that's June. Look at the shift. And what's really interesting is that we're moving back to a market where land is no longer a four-letter word, but prices are moving up. But check out these 2 points that people have shared with us during the builder survey. Land prices are skyrocketing, we can't underwrite. Number 2, The publics are winning deals with aggressive underwriting assumptions. I'll get back to the publics in just a second. But here's the other fascinating thing. When you ask, okay, so what are you really doing? Well, they're basically cautiously moving forward or full steam ahead. Look at the full steam ahead element. Go back to July a year ago and look at now. It's reversed pretty strongly. So prices are up, the interest is out there, publics are prominent. Okay, that's what's happening. Now look at the disruption in each of these factors: government services, labor, supply, land. If you go back to the time during COVID, and Ellie and I would share this, look at the 2020, 2021 timeframe. There was more disruption than there is now, but that's not to say that disruption is gone. It's just alleviated a little bit. Now, labor is probably the one that's changed the most, but government services is still a bee in the bonnet for most builders. And if you ultimately ask builders, they want to continue building, but remember, they're looking at this cautiously. They're thinking about affordability. And when we ask, what are your housing start plans? Look at the right-hand side of this. When we go up 1 to 5%, 6 to 10, or up more than 10%, about 55% of the respondents have turned thumbs up. Now look at the left-hand side of the teal. Go back to November, the vast majority were saying, the market's down, we anticipate slowing significantly. So things have pivoted. Now, it didn't happen overnight, but things have pivoted. Now, one of the challenges, and particularly if you are a private builder, is the availability of acquisition, development, construction. And look at both of these tests that we have. NHB has their own, and then the Federal Senior Loan Officer Opinion Survey on Bank Lending Practices. That's a mouthful. You can see that basically we're in a place where credit is strangled. And oops, I'm going a little too fast there. Hold on, let me go right back here. If you look at that dark line we put in, loosening is above and tightening is below. And you can see directionally, the Fed is going, it's still tough. NHB says it's softened a little, but we're still in a very, very difficult environment. I would call it basically a noose. Now, I mentioned something about the publics, and we're tracking the publics, and some of their advantages, of course, access to capital, economies of scale, right of first refusal. I mean, they're big and they're strong. But when we think about where they are and how it's shifted, look at this evolution in just the last 15 years. And that's almost 47% of the market controlled by publics. And this is the closings, 2005 to 2023. And if we include the big privates like Weekly and Shea and Ashton Woods and Clayton, that number is more like 51 or 52%. And while they're not public, they still have superior access to capital and lower cost of capital. So ultimately, what are the markets like and how are the public builder share different? Look left to right, Vegas and San Jose and Denver. We actually gave you a little bit of detail in Vegas because it is crazy. Vegas has the vast majority of its market controlled by the publics, and here they are. Within here, the only builder that's not a public is Touchstone Living, and that's Tom McCormick. And you can see that he's also one of the lower price builders, getting to the entry level and move up. We anticipate that this will continue. And we also anticipate we'll see more M&A on the horizon over the next 2 years for all the reasons we've talked about, but not the least of which is the capital markets. So here, let us take you to our final thoughts. And as we often do, I almost forgot. Allie and I have been behind the scenes, guys, talking about this whole concept of shifting, offices to apartments, and it doesn't seem to have taken root very well yet. However, look at Boston. Boston's now talking about offering up to 75% tax breaks to office building owners. And our conversations internally really have to do with the fact that to make this work, it's going to have to be a public-private partnership. So keep an eye on that. We certainly are going to. I know that Kimberly Byron, my partner and who leads our multifamily world, is definitely paying attention to that. A couple final thoughts. We always like to share good news before we go. And there's a new discovery about a zombie cell and a molecule that can help us age slower. I'm in because time is going by too fast. This next factor I absolutely love. Roger Anderson, a 54-year-old guy in Monrovia, has created an app that uses AI to mess with the robocallers. And basically chat bots will answer for you, and they'll say things like, hello, 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 there's a bee on my arm, and try to keep people on the line as long as possible until they're frustrated and hang up. Best way to deal with telemarketers. And this brilliant math coach, Po-Shen Lo, is teaching kids how to outsmart AI. And really it comes down to knowing about math and calculus, but also being a critical thinker. I love this guy, and I'm going to follow him and see where he takes us. Couple more. This gentleman who is insane, this is Joseph Salek. He did almost a 10-hour plank. What in heaven's name was he thinking? But I had to show that because he set a record. And this neighbor, this young man who's got some learning disabilities, knocked on a neighbor's door and asked if there were any kids that he could play with. And this neighbor took heart, put this video, which was taken with his Ring camera, put it up on TikTok. There's been 69 million views. The kid has had untold amounts of dollars put his way for school. He's got special needs, but his neighborhood had rallied around him. I think it's fantastic. And then I just have to call out Shaq. He was at Home Depot, met a mom and a daughter. They were buying a washer and dryer, and because he's a good guy, he bought it for him. Now, here's what we'll leave you with. In the last couple of weeks, I've lost a couple of friends, and it's been a heavy conversation. I've been doing research. I've been thinking about it, the meaning of life, all these factors. And I came across an article from this gentleman, Dr. Alistair McAlpine. He's a palliative care physician for kids in Cape Town. And palliative care, if you are familiar with it, is end of life. And the wisdom that he's learned from these kids between the ages of 4 to 9, I just have to share. Ultimately, these are the factors. Oops, I'm giving that away too fast. Nobody wishes they spent more time online. Animals are key. We love our parents. You heard me say that about Allie. Got to eat ice cream. Reading makes a difference. Worrying is a waste of time. Everyone loves the beach. Kindness matters. Laughter is the best medicine. You know that, Allie. Kids love their toys. And it's very, very hot out there. And I know that my friends in Arizona are now in their 19th day of 110 degrees. No matter what's going on in your life, if you eat ice cream, things will be a little bit better. But remember those things. They came from kids at the end of their lives, and they were able to point out the things that really matter. With that, ladies and gentlemen, it is a wrap for today. Please reach out to us with any questions. We will have this taped, and you guys will have access to it by tomorrow. Thank you for the questions. Keep them coming on behalf of Valerie and I, and Amanda and Valerie. We love having you guys here. Stay with us, and we'll see you next time. Thank you.